Another new webinar of Mehta Mehta. Today's topic is preference shares. Friends, you might be thinking, what is so great in preferences? That entire session on preferences. Preferences means rights, shares which have preference over the dividend and at the return of share capital. What is so great? Board resolution, members resolution, that form filing and sale certificate. I should ask the question, why this preference share company will issue? Can you think that? There is equity, there is a debt. Why this in-between company chooses? Understand that. And here comes the crux. And keep in mind, when the preference share is there, this question should come, why company has chosen this path? Because it's a hybrid model of shares and debt. And why it is used, when it is used, how it is useful. This we should understand as a company secretary. We should not limit ourselves to only process, but why? And what is the benefit? What is the disadvantage? And what care should be taken? Friends, keep in mind, when preference share is there is a timeline for redemption. So keep in mind when these shares are due for redemption. Otherwise, you may skip the redemption and it will create a problem. So honestly, from my student days, I have many curiosity. I keep on answering over the period. And as and when preference share is there, always I try to understand why. And that's why I selected the topic, and none other than exactly similar line thought person with me on the panel, Mr. Kalidas, our own Kalidas Ramaswamy. Everyone knows him. No need of introduction. Very well-known personality. But as a formality, I have to introduce him formally. Short introduction, I'll say. He is a fellow member of ICICI, MBA Finance from Jadavpur University, Kolkata, BCom Honors from St. Xavier's College, Kolkata. He has more than 4 decades of experience in industry. Friends, 4 decades, more than 4 decades. After starting professional career in 1978, worked in leading companies such as Ambuja Cement, Company Secretary VP of Reliance Power Limited, Company Secretary Head Compliance, ACC Limited, and now in practice as a partner of leading firm of practicing company secretary. He was visiting faculty of XLRI Jamshedpur, a premium management institute, author of more than 100 articles on issues relating to corporate laws, heavy regulation, corporate governance, and articles are published in Charter Secretaries, Taxmen, SEBI, corporate law web portals such as lawyerclubindia.com, caclubindia.com. Is a regular speaker in seminars, conferences organized across the country by professional bodies. He was a member of Secretarial Standard Board of the ICICI T20, presently member of the Expert Committee on Secretarial Standard. He is the author of following books: Law and Practice Relating to Company Meetings, Law and Practice of Directors, Board Management, KMPs, Specialist Editor of C.R. Datta on Company Law, Specialist Editor MC Bandari Company Law, Specialist Editor Ramaya on Company Law. Welcome, sir. Welcome to the webinar.
Thank you very much. It's indeed a pleasure for me to join in this webinar. And I have known Dipti for years, ever since the time I came to Bombay. It's always been a pleasure to interact with her and with Atul. And this is a very nice initiative that this firm has taken to sort of keep the fraternity updated on various topics of contemporary interest, and I'm happy to be part of this.
Thanks a lot, sir. It's our opportunity. Friends, as usual, on the topic, everyone can put the question in the chat box. If required, we'll ask you to unmute. You can ask parallelly. We'll take the question when the topic is going through. As a panelist, I request anyone can unmute, intro the presentation and talk. To start with, I'll request Mr. Kalidas to give his view on the topic, and then Mr. Bala for 2 minutes on his view on the topic, and then we'll start the presentation. Friends, one thing, Today, my presenter, Suchita, is having running fever since 2 days, but still she is presenting it. So I really applaud her efforts. She has worked hard on this. Thanks, Suchita. I really appreciate with fever you are giving presentation. So bear if she little bit cough or sneeze, and she may switch off the video. If required in between, her colleague, Mr. Prashant, will take over. Okay, over to Mr. Kalidas, please.
Thank you. I have a few words only, because I think it's important that as a panelist, I should restrict myself to a limited time in terms of discussion, and leave the floor open for the presenter. But, prima facie, the issue of preference shares would appear to be a very simple concept. You issue shares the way you issue equity. The only difference being that preference shares are supposed to carry it's a hybrid security, in the sense that it has the characteristics of both debt as also equity, because there's a fixed return on investment, and under law you can't issue irredeemable preference shares. So therefore, preference capital is not considered as permanent capital. In fact, in financial parlance, we talk about preference capital as being period capital. And in fact, if you look at the accounting standards and the Ind AS rules that have come, although in terms of description, it forms a part of capital in the balance sheet, but it is being considered as a hybrid security. Beg your pardon, it's a subordinate debt. And therefore, in financial parlance, the preference capital is not considered as a part of the shareholders' funds. It's not part of net worth. It has to be considered as a debt, and only if the preference capital has some characteristics of equity. Normally, you have a fixed coupon rate of interest, a dividend on the preference shares. But if the preference shares have a fluctuating rate, in the sense that you make those shares participative, so that you get over and above the fixed rate of dividend, a certain rate as declared by the board, then it can be considered as part of capital. Otherwise, it is supposed to be a subordinate debt. And therefore, there are many questions which arise, which I'm sure the presenter will address, whether preference capital should be considered as part of the aggregate of paid up capital and free reserves and securities premium for various purposes, such as for borrowing capacity under Section 181C, for the purpose of issuing, for raising public deposits under Section 74, for the purposes of determining your investment limits under Section 186. In my view, notwithstanding that the preference shares do form a part of paid up share capital as per the definition of paid up share capital, given the fact that it has characteristics of debt and not so much of equity, a conservative view would be not to consider the preference capital as part of the aggregate of paid up capital and free reserves. The reason is basically this, that if you add preference shares, then your ability to borrow gets artificially increased, given the fact that your preference capital has a certain periodicity. And secondly, supposing you are making issue at a time you are raising capital funds by way of borrowing at the 10th, say 9th year of your, the preference shares, and the redemption is due 1 year, you will be calculated with reference to a preference capital, which will disappear the next year. So artificially, you are jacking up your capacity. And also, given the fact that in accounting parlance, it is considered as subordinate debt, a conservative view is not to consider the preference shares as part of that. The second question that, which we need to understand is the fine distinction. There's a subtle difference insofar as the rights of the preference shareholders are concerned. The preference shareholders have the right only to participate in those matters which affect their interest. If there is a reduction in the coupon rate, or you crash the period of
so your audio
years,
is like, your audio is getting disconnected in between.
Okay, what I will do is that, I will disconnect the video. My video will stop, then it will probably improve, because I've stopped my video. It's not necessary for people to see me. So is the voice better now?
No, now clear.
Yeah,
Thanks.
okay. So that's the problem. So I've switched off the video. So as I was saying, in the present law, the preference shareholders get the right to participate in all matters relating to the company. If there is a break in the dividend for 2 years, if dividend is unpaid for 2 years, then they don't get the right to participate. On the other hand, under the old act, whether it was, if it was cumulative preference or non-cumulative, the right to participate arose only if cumulative dividend was in arrears for 2 years. So that way, the present act is much more stringent and more beneficial to the preference shareholder. And the third question, which is important to understand, is that whether a preference shareholder is a member of the company. If you look at section 255, which defines membership, it simply talks about somebody whose name is appearing in the register. A preference shareholder is as much a member as a equity shareholder. Only thing is that his membership goes once the redemption happens. So the question is, whether you have to send a notice to the preference shareholder for the annual general meeting. The answer is yes. And that is also supported by a departmental circular which was issued sometime in 1977. And the fourth and the last point which I wish to address is that, many people, you see, particularly in this new age where everything has a shortcut, given the fact that people have the advantage of the internet, there is an assumption that if you are paying the assumption is that since preference shares carry a coupon rate of dividend, there is no need for the shareholders to approve in the annual general meeting the declaration of preference dividend. That is a very, in fact, our guidance, no, our secretarial standard 3 also, of course, it's not mandatory, but it says that when you are paying the coupon rate of dividend, you don't have to seek the shareholders' approval in the annual general meeting. That is wrong, given the fact that if you look at section 102, the items of ordinary business, it says declaration of any dividend. So any would include also preference dividend. So please do not mistake, if you have got equity and preference shares, do not make the mistake of not taking the approval of your shareholders for declaring preference dividend. You have to have a resolution, and once you declare the preference dividend, then only you can address the issue of equity. Now, this is all that I wanted to share. And if there are some questions which come along in the chat box, I will be happy to answer. Over to you, Dipti.
Thank you. Mr. Bala, your view on the topic, please.
Good morning to all of you. I have a great pleasure in welcoming you to this topic of preference share. As we understand in the common parlor, preference share, we all studied, we all know, oh, it carries some preferential rights in terms of dividends, in terms of winding up and getting the capital back as a preference. That is what we have. But there are much more than this what we think. As Dipti Madam puts it and Kalidas has puts it, he has already gone over various nitty-gritties on this preference share. And again, there is a listed companies. If the company lists the shares, only the preference share, whether it is a listed company or not. Because normally people go for the equity listing and the preference also getting listed. But the question is, as Kalidas has puts it, equity is definitely a capital of the company. Preference is actually a debt. Rather, it's a long-term debt. Even in the accounting parlor also, it is actually treated, the treatment is always given what you call a long-term borrowings. And as well, the dividend paid is also charged to the profit and loss account as the charges. That is the issue. So in this case, there are a lot of nitty-gritty regarding to the secretarial methodology to be followed, what is to be adhered, how it is to be treated in the account, to be treated in the balance sheet and present in the financial statement. The arrears, it will always appear as the liability of the account. So with all the things, it is regarding to the various procedural issues, the treatment of the preference share in terms of the financial statements, in terms of the accounting statements, and also the president is going to give us some decided case laws on this, what are the rights of the preference share rights between the equity shares and the preference share right between the equity shares and the debt equipment, etc. And other thing and all. I think we'll have a lot of things get clarified on this subject today. I think with this, I'll ask the presenter to move on to the presentation. And if people are free to ask any questions and clarification, etc., we have an expert with us who has actually dealt on this subject. I think he will share his practical experience. We'll have the just to clarify things for various our doubts. Thanks a lot.
Thank you, Mr. Bala. Thanks, Mr. Kalidas, for touching the right topic, right points and clarification people will think and raising questions in the mind of participants, and Mr. Bala for your interesting comment. Over to Suchita. Now you can start the presentation, please.
Yeah, good morning, everyone. Myself, Suchita Surve. So I'm here to give you an insight on the preference shares today. The various issues in the issuing of preference shares, then there are benefits to the company and to the preference shareholders, and redemption of preference shares, everything we are going to discuss over here today. So without making any delay, I'll start with the presentation. So just to give a brief on the topic, there are two types of shares, that is equity shares and preference shares. So equity shareholders are we can say equity shareholders are the real owners of the company, as they have the voting rights on all matters of the company. Like they while preference shareholders do not have the management decision making powers, equity shareholders have that powers to decide decision making powers in the management of the company. Preference shareholders are given priority in dividend of payment dividend and the repayment of capital over the equity shares in the company. The rate of dividend on equity share is fluctuates. Like equity shareholders may get dividend or may not get dividend depending on the profits earned by the company. However, the preference shareholders carry fixed rate of dividend and preferential treatment whenever a dividend is declared by the company. Let us discuss on the governing regulations. Section 55 of the Companies Act 2013, read with Rule 9 of Company Share Capital and Debentures Rule, allows the issue and redemption of preference shares. Section 55(1) puts a ban on issuance of irredeemable preference shares. Like a company cannot issue preference shares which are irredeemable. Securities and Exchange Board of India Regulations 1992, which covers listing of preference shares. We are going to discuss in detail on listing of preference shares later in the presentation. With this background, let us look into the various procedural aspects such as terms and conditions for issue and redemption of preference shares. So definition of preference shares. What is preference shares? So preference shares are those shares which have two preferential rights. That is, right to dividend, receive dividend at a given rate before any dividend is declared and paid to the equity shareholders. So this right is subject to declaration by the company and subject to availability of profits in the company. So rate of dividend is normally fixed on the preference shareholders, on the preference shares, like that fixed rate only they will get the dividend. Then right to repayment of capital at the time of liquidation and winding up by the company. Before any capital repayment is done to the equity shareholders, the preference shareholders get the right to repay their capital. As their name indicates, these shares have preferential rights over the equity shareholders. So preference shares are considered as a hybrid security, as it has the characteristics of both debt and equity investments. So it is considered as a debt also, and moreover, it forms a part of capital also, because these are shares which is issued by the company. So what are preference shares? Whether it is a capital or it is a debt. So preference shares is a long-term source of finance for the company. They have elements of both equity shares and both capital and the debt. What are their features as equity? So as a capital. Dividend from profit after tax. So preference shareholders get dividend from profit after tax. If after tax the company has any profits in the hands, then only it can pay dividend to the preference shareholders. And it is a decision management discretion over payment. If only when there is a sufficient profit in the company, then the preference shareholders get dividend. What are the features as debt? Fixed dividend. As there is a fixed interest on the debt, the dividend on the preference shares is fixed. There are fixed percentage on which a dividend is paid to the preference shareholders. Preference over stock. So they have preference over the equity share capital of the company. Before any dividend or is declared on the equity shareholders, the dividend is paid to the the dividend is paid to the preference shareholders. No voting rights. Preference shareholders do not have any voting rights. The voting rights are subject to their wherever their rights are affected directly, then only they get voting rights over there. Otherwise, the preference shareholders do not have any voting rights in the company. No share in the earnings. The preference shareholders do not get any share in the earnings of the company rather than the participating preference shares. If the preference shares are participating share, then only they get the share in the earnings of the company. Fixed maturity. A company can issue preference shares up to 20 years only, except in case of infrastructure projects, the period is up to 30 years. Like preference shareholders needs to be redeemed within that 20 years period. So whether preference shares will be the capital or debt, it is a discussion point. I would like Mr. Kalidas sir to show some to throw some highlight on this, whether we will consider preference shareholders as a capital or debt.
As Suchita mentioned, preference capital has the characteristics of debt as also equity, because it is part of capital as per the definition of paid up capital under the Act. At the same time, it has the characteristics of debt because it has a limited shelf life and you can't have irredeemable preference capital. And thirdly, there is a fixed rate of dividend. Of course, the dividend in case of preference is also payable only if there is a profit. Or of course, alternately, you want to pay dividend out of past reserves. The point is that whether the preference capital should be considered as a part of shareholder fund or a part of net worth. Now, the conservative view would be to consider preference capital as a debt and not consider as part of the net worth for the purposes of calculating some important thresholds in the Act, such as the threshold under Section 181C, determination of your ability to borrow. You need the permission of your shareholders when you want to borrow in aggregate in excess of the aggregate of the paid up capital, share capital, and paid up share capital, securities premium, and free. The point is that whether preference capital should be considered as part of paid. In my view, the answer is no, given the fact you have to, as I said, you have to consider a preference as debt. And secondly, if you look at the form of the advertisement for
so your voice is
public, deposit.
Okay, sir, your audio in between. Can you again repeat last sentence, please?
I'll stop my video. And again, second point I wanted to make is that if you look at the form of advertisement that the board has to approve for the purposes of raising public deposits, you will see that it is talking about it. Of course, it talks about paid up share capital and it does not give a breakup, but it says it's net worth. Now, net worth normally is something which is analogous to shareholders fund, and therefore net worth is something which only the equity shareholders have a prerogative to participate in. So to my mind, from this point of view also, the preference capital should not be considered, because otherwise your ability to raise public deposits is going to be higher, because your aggregate 25% or 10% will be calculated considering both equity and preference. Now that's wrong. And the third thing is that particularly where it comes to making of investments or loans also, if you consider your preference capital, in that case, the preference cap, it will jack up your ability to make investments. And if you look at the contemporary law on the subject, now, as you are aware, Section 252, which defines a listed company, was amended by the Companies Act in 2021 by the insert of a proviso, which says that certain securities as approved and discussed by the government with the Reserve Bank of India shall not be considered for the purposes of a company being considered as a listed entity. And if you look at the SEBI LODR regulations, which now talk about listing of equity and of course high value non-convertible debt instruments, if you see, it is clearly mentioned if a company does not list its equity shares but lists its preference shares, then it is not considered as a listed entity. And there was another confusion which was caused in the present act. If you recall, in the definition rules, there was a definition for total share capital. Of course, this definition has been since withdrawn. The total share capital was made up of two components: first, equity, and preference, which clearly suggested that preference is to be considered differently. So, although by definition, the term preference capital is part of paid up share capital, my conservative view, I'm always very conservative, given the fact that I've been in the profession for over 40 years and I've never tried to cut corners with the law. Given the fact that you should always be conservative in a procedural law, I am of the considered view that the preference share capital should not be considered as part of the aggregate paid up capital. It should be considered as a debt. More so when you also consider the requirement of Ind AS 32, which talks about preference capital as being a subordinate debt, right? Thank you.
So it is, thanks. So it is, you can say the, since Indes is selling, it is a subordinate debt, not a share capital. We should consider it as a, because that is, if we say Companies Act 2013, it is share capital.
I fully agree with you, Dipti, on this. If you want to, but then what I'm trying to say is that, you see, a company can take advantage of the position in the law because the definition of paid up share capital does consider preference capital. But then what are we advocating as professionals? We are advocating as professionals conservatism. So therefore, in my view, given the fact that, you see, you can, and these decisions such as approval of shareholders in the 181C are not period decisions. These are permanent. So if tomorrow you have, let us say, taken a consent of 30,000 crores for borrowing, and of which, let's say, 10,000 was preference capital, which has since been redeemed, then you are actually exposing the shareholder to the risk of higher borrowing than the company is entitled to. So to my mind, I will always maintain that the preference share capital, although it is part of paid up capital under the Act, should not be considered for these purposes.
So what if the preference shares are convertible in nature? Like they are going to convert into.
That is a good point. Then, if the preference shares are convertible in nature, then there is a certain weightage to it, because it is going to be, albeit it is going to be converted later, but it is surely going to be converted. In that case, there is enough argument in support to say that it should form a part of paid up capital, not otherwise. If it is redeemable preference capital, to my mind, or if it is not participating preference capital, to my mind, it should not be considered as part of capital.
So if it is redeemable and participative, then we can or we cannot.
Yes, you see, in fact, if you look at Ind AS 32, it clearly says that if there are certain features of equity in the preference capital issue, then you can consider it as part of capital. So if one of the features of equity is if the dividend is fluctuating. If there is a fixed rate and on top of it, if the board can declare rate of dividend, then it is participating preference. In that case, there is considering it as part of capital.
Dipti, I have
my view on this, and
Sir, your voice again.
I'm not saying that I never push my views down.
Sir, Dipti, I have a little different view. I'll say with my logic also. I agree with what the sir was saying. But if we now look at the provisions of the Companies Act, even if it is a preference share, now if preference share is compulsorily convertible, either immediately or later on, it should be considered the part of the equity. And even if it is not convertible, now let us look at this rationale. Now, assuming it is not convertible and let's say it is repayable after 10 years. Now, how do the repayment can happen? either you will transfer some profit from your general reserves or from there to capital reserves, and then only you can redeem, or you bring in equity and from there you can repay. So eventually the total equity a portion will remain the intact, and otherwise also, because it is paid only after the debts are paid. In case of winding up, though they have a preference over the equity holder, but they are paid after the debt. So you can say it is between the pure equity, means pure risk, and little lesser risk between the equity holders. My view is it should be considered as a part of the share capital or net worth.
In fact, if you see most of the balance sheet of the companies, especially listed companies, especially if you see the renowned group companies, etc., this preference share capital is always presented as a long-term borrowing. It is not accounted as a capital. I am actually totally in agreement with the colleagues. This all said and done. So long as it is not the convertible character is there, it will be a long-term capital. That is what it is actually treated. Even our accounting standard also advocates the same.
Yeah. Now, if you look at the Indias clearly says that if preference shares are redeemable, it is nothing but the debt.
Yeah. In fact, if you
Under
see
Ind,
the
but
presentation,
under age it is still.
Correct. I agree with you. But the thing is, as you rightly say, we should always think in the best interest of the largest stakeholders of the company. Unnecessarily adding to the paid-up capital and giving the artificial borrowing, artificial collecting the deposit, etc., putting the public in the problem is not actually admissible.
There is also another point I want to add in
Yes.
support of what Mr. Balakrishnan had said. There's one more point. You see, if it were considered as capital, then why is it that under Section 62, when you are making a rights issue, why are you not making a rights issue to your preference shareholders? Why are you only restricting the rights issue to equity shareholders? If you say that there is no difference between equity and preference, then both categories of shareholders should get to participate in the rights.
No,
Why does the law clearly say that it is only the equity shareholder who get it?
Yeah, I'll answer your question, sir.
Yes, please.
Between the shareholders, there is a differentiation, equity and the preference. Preference shareholders have a preference over equity shareholders, including they do not get the right to participate in the right shares. But obviously, when they are compared with the debt or a loan, they are like equity holders. No, first the debt will be paid, and then only if anything remains will be paid to the shareholders. Now, assuming that after paying everybody, now only 10 rupees is left, and now 100 rupees is the share capital, out of which 50 is equity and 50 is preference, then only preference holder will get, equity will get nothing. So differentiation is between among the equity shareholders, but both together, when viewed by outsiders, they are the owners.
I agree with, they are not the preference shareholders, are not the owners of capital. I stick to my view. Secondly, you are looking at a procedural law, and in a procedural law, the doctrine that is always advocated is the doctrine of conservatism. And to my mind, the conservative view, I repeat, would be to say that preference capital should not be considered for important purposes such as borrowing, investments, etc. I am very firm in this.
No, I agree. I mean, forget about legality from the conservatism point. Since you argued that way, if I were to lend something to the company and I'll take 3-5 years, then future profit also first they will have to transfer to capital reserves if they want to repay. So I will take preference as a part of equity for working out some of my ratios before taking the call whether should I lend or should I not lend. I mean, this is beyond the law. I mean, I was listening to you, so I just put my
financial, as far as I am aware, no financial analyst considers preference capital as part of shareholder funds. No financial analyst.
To an extent, right? Because let's say hypothetically that my equity is 10, my reserve and surplus is 50, and I have a 20 rupees preference shares. And let's say it is fallen due. So what I can do, I can simply repay. I will transfer 20 rupees from my general reserve to capital reserve. So my total remains basically the same. So from that point, but if I take 2, 3, 4 years in future, then future profit will automatically go to the reserves they will not be able to use, assuming they want to redeem preferences out of the future profit. So they have to compulsorily transfer to capital reserves, which will form part of the equity kind of a thing. It cannot be utilized for some other purpose. So for that limited ratios, and this is beyond the law. As a layman, if I have to lend, this is how I look at it.
Fair
So
enough.
I just put forth my view, Mr. Kalidas.
Nikhil, you
there are always
Nick-
differences.
Nikhil,
There are
in
always two views possible.
I think we can argue on this until the cows come home.
That's true.
Therefore, I think we
Let
can
us
move on.
let us take it further.
Nikhil,
Yeah.
Nikhil, you can always have your view.
No, everybody will have a view.
No, I am coming to it because I have a pleasure in working with the different companies. Lastly, I was associated with the Vodafone group of companies, which had almost about 20 companies.
Right.
Okay, that means private companies, public companies, unlisted companies, all these companies. That I was also in the listed company. And some of all these companies, they actually employ what you call big four firms as their auditors. I have a pleasure was working with the big four firms from the KPMG and the Price Waterhouse, and the view taken by all these big four firms and all these companies consistently, in my practical experience, the preference share has been treated only long-term borrowing. Nowhere it is treated as the capital. And also in calculating the ratio, etc., borrowing purpose, deposit purpose also, it was never considered. So as Kalidas actually puts it, in the larger interest of the stakeholders, we should take the right view, although there is a scope for interpreting, oh, company doesn't say that, and the accounting standard, this is possible, it is possible. But ultimately, what you want to take in the larger interest of the stakeholder, that is what professionals will have to look into. That is my view.
Yeah,
Bala Shailesh here.
Yeah.
Bala, I wonder how RBI treats this for NBFCs, because NBFCs are big borrowers in the market, and RBI prescribes rules for calculating net owned funds and for capital adequacy ratio.
And
I'm not too sure how RBI is treating it. Does it treat it as shareholders' funds, or does it treat it as debt?
maybe
RBI.
it must be tier 2 capital for NBFC.
But tier 2 capital is capital only, Tier 2 capital is capital.
Yeah, but it's not considered as part of shareholder funds. It's tier 2 capital is not part of shareholder funds.
But at the same time, not debt.
No, but you see, it has to be considered.
I'm not sure what RBI does. I'm not sure.
No, the reason why it is capital is because it is actually, you don't get a tax rebate on the interest payout. If when you pay debt, interest on debt, you get a tax rebate on the interest paid. Actually, when you are paying preference dividend, it is actually appropriation of profit and not a charge against the profit. And that's exactly the reason why it has to continue to be called as capital.
What about this practically banks and all that, when the company go, how it is treated? Is debt or equity by financial institutions?
Banks, to the best of my knowledge, Dipti, do not consider preference capital as part of tier 2 capital.
Bank never considered, because I had companies where they made a larger borrowing. Whenever we work out what is our borrowing limit, etc., bank never considers preference share capital as a part of the share capital.
Okay. So there are two views, but the majority view go with the conservative view that it should not be considered as share capital for the purpose of borrowing, investment, and all that limits. So what about if the same thing we can think, then in that case, what about the subsidiary company, associate company, related party transaction? How it should be treated there? So you are.
Dipti, that means if I invest in my subsidiary by way of reference, it is a RPT. Disclosure will come in financial statement that this is the transaction during the year.
See, in case of subsidiary relationship, you calculate whether the company is your subsidiary or not in terms of voting power.
Voting rights.
In terms of voting power, voting preference shares do not give you voting power. So if you have got preference capital more than 50%, but equity less than 50%, unless you have management control the preference, the subsidiary, it cannot be called a subsidiary.
Okay.
But Kalidas ji, in Ind AS again, there is a totally different concept. Assuming I don't own a single share, but I have an agreement with the company saying that company will have only 10 directors, out of which 6 directors I will appoint. Still, it is a subsidiary.
No, that's not in the
I
Indian.
agree, I
It is in
agree,
the
I
Act
agree. But
itself.
you are right.
The Act itself provides for management control. That I agree with you. There are two ways of making a. But the point is that what I'm trying to say is that if you are holding control over paid up preference share capital in the subsidiary and no management control, then if your equity is not above 50%, then it cannot be called a subsidiary.
Right, absolutely right. I agree with you.
So Balaji, I'll share you another incident. In the case, what has happened? The equity was 1 crore, preference was 10 crores, and it was a non-cumulative. And as per the provision of the law, I think 2 or 3 years consecutive, if you don't pay the dividend, then they get a right to vote on all the resolutions. Now your voting power is 11 crore. Out of which 10 crores is held by me. So just being a preference shareholder, I was a holding company.
That's a different situation.
So based on the law, situation may arise where because of preferences you become a holding company.
The question is that per se, is it a subsidiary or not? Unless you have circumstances visited under 47(2), per se there is no voting power.
Yeah, per se there is no voting power. I agree.
That's what we should look at, no?
Okay. And what about RPT, related party transaction?
Well, if it is RPT,
then if your equity holding is beyond 20%, then it is an associate.
No, what Dipti talks about is RPT. Let's say first time I am investing 60% in a company and making it my subsidiary. So when I am investing 60%, it is RPT.
Okay.
So disclosure will come in financial statement that during the year I invested X amount.
So if
her question is different. Her question is whether the preference capital, if preference capital is more, whether it is a RPT. Am I right?
Yeah.
That case, you will have to see whether there is, whether the holding company, rather, if there is some management control, if there is accustomed to act, there are various situations in Section 276 which you will have to apply, whether it is an associate, even by its equity holding, all these will have to be considered.
Okay. Now, I think there are many questions which are there. We can take it now or just because since we are talking and that's why this topic is taken. See what is the difference and how complex this topic is. The question here, panel, do we need to fix the conversion price of CCPS? And before that, I have one question, sorry. When we say for 2 years, dividend is not paid, voting rights is given to preference shareholders. Now, dividend not declared and paid or dividend not paid. So because I don't have profit, I don't declare. I have profit, but I don't declare. In which situation, both situation, preference shareholder will get voting rights?
Yes.
Yeah.
According to me, yes.
Yes.
Yeah. Only restriction is that I cannot declare dividend on equity without giving on preference.
So if I fail to pay dividend, whether because I don't have profit or because
no intention to declare. Let's take it that. But then you are ceding the control to preference shareholders.
Oh, okay. Okay. Thanks for clarification. Okay. The first question, yes, sir. Anyone else want to add it?
Yes, I had a related question. I don't know. See, when preference shareholders get voting rights, and if these are very large in number, and the holder of those preference shares exceeds 25% of the total voting rights, would there be need to make an open offer?
I think so, because the capital remains preference. It is not as if that the preference shareholder has become an equity shareholder.
No, but he gets voting rights.
Yeah, he's got voting rights, but it is not as if the capital has changed in character. So it's only the voting right. So the nature of the capital remains the same. I don't think it triggers off an open offer.
Open offer depends on voting rights also, no? Or not?
No, open offer is, when you're talking about vanilla voting rights emerging out of equity. Okay. You don't talk about open offer, which is coming voting rights which is coming through an artificial process in the law.
No, I don't think there is any such thing as vanilla voting rights. It is voting rights. And if you get voting rights by way of non-receipt of preference dividend, would it not? I'm not sure. I'm just posing this question, but I have not seen any such thing as vanilla voting rights or anything similar to that.
Why by vanilla? I meant vanilla is when I buy equity shares.
I understand. You mean ordinary and normal course. But
So,
I think the term used is voting rights.
No,
And
of course, the law doesn't use vanilla. I mean, it doesn't. I'm just using that expression. But to my mind, I reiterate my point that if dividend is in arrears, then it does not trigger off an open offer. See, I mean, it would be paradoxical. When you are not able to pay dividend, how do you expect to make an open offer? I mean, I don't know. I don't really know why.
Shareholder has to make. That shareholder has to make, not the company.
No, the promoter may also want to take more stake, right?
So that is another problem arising out of preference shares, which the law has not properly addressed, I think.
Shaileshji, that is right, but this acquisition of voting right is only partial, or you can call it a temporary. Suppose in one AGM, because of non-payment of dividend on preference shares, I have a right to vote on all the resolutions. And say after 1 week, they have a profit, but they have not declared. So now they have declared it. So next AGM or EGM,
absolutely.
they can't vote.
Agree.
But that way,
I agree. Under LODR or from SEBI's point of view, whether I need to make an open offer just because I was holding preferences is still a dicey, and I have no solution for that. But I don't think, and even if I make an offer, what will I make an offer for? Preference shares or equity shareholders?
Equity shares. Equity shares.
Because as a preference shareholders, I have a right to vote on all the resolutions so long as there is a default in payment of dividend. So as a preference shareholder, should I buy other preference shareholders, or have I to make open offer for equity? Because if I make an open offer to equity, it means I have a permanent voting right on all the resolutions forever.
And further, it is by operation of law it happens.
Exactly.
Not my volition.
Yeah, an operation of law because of default. Because of default.
Okay, there is a question from Mr. Vikas. Do we need to fix the conversion price of CCPS at the time of issuance of CCPS? Ms. Ashwini has already answered Rule 13. It can be fixed at the time of issuance or 1 month before conversion. The second question, is it mandatory to take valuation report for the same?
I think if it is, to my mind, yes, a valuation would be necessary if the preference capital is a private offer.
Valuation will be actually recorded in a couple of cases. The valuation in the Vodafone group of companies, we actually got it done. So valuation will be actually confirmed.
Valuation is required.
Yeah.
Okay. Since you are not answered. Okay. Thanks, Ashwini. Jatin Desai, can zero coupon deep discount bonds with clause of conversion into preference shares be issued by infra company? Can I repeat again slowly? Can zero coupon deep discount bonds with clause of conversion into preference shares be issued by infra company?
Yeah, I think so.
Yeah.
I think to my mind also it can be done actually, because I remember in one of the cases where we went to NCLT for a merger and amalgamations, some other the merging party, they wanted to have a combination of equity and preference. In fact, that time they even issued the equity in the part of the preference share and equity share. I think this is possible, it can be done.
But then will be the tenure, because there are two instruments here. So which tenure will be considered?
If it is a deep discount bond which is secured, then of course the period cannot exceed 10 years. And if it is a deep discount bond which is unsecured, then it could probably be considered as part of deemed deposits.
And but one thing, this is also attending the question whether the preference share is a share or debt, because bond is a debt and share preference share is, if we consider equity, debt cannot be converted into we are converting into debt, equity cannot be debt. Okay, so it can be done. right?
Yeah, it can be.
Okay. Do we require valuation report? Okay, we answered this. No, sorry. Do we require a valuation report for conversion of CCPS to equity if company has entered into shareholders agreement?
I think in case of shareholders agreement, the conversion price and everything is decided earlier only at the time of issuing the preference shares. That terms and everything are decided in the shareholders agreement, and hence in that case it is not required. We take it at the time of issuance only.
Panel, any view you have? Sir, you are on mute, sir.
Yeah, I have no view on this. I mean, I think it depends on what has been agreed between the two parties in the case of a private placement.
Okay. Even in case of convertible preference shares, it should be treated as part of capital once the shares are converted to equity, right? That is the question.
I think this was actually discussed, no? When it's a convertible,
Yeah.
it was to be discussed elaborately.
This was also in case of NBFC, does CCPS form a part of tier 1 capital, tier 2? We discussed tier 2.
Yeah.
Do we require valuation report if preference shares are issued on right basis?
Yes.
Yes, it is required.
Even though right shares?
Yeah.
Okay. Okay, this is completing the questions. Suchita, you can start the presentation, please.
Yeah. So moving ahead on the next slide. So these are some characteristics of preference shares. Most of them we have already discussed in the earlier slides. So preferential treatment. They have preferential treatment over payment of dividend. Before dividend is any dividend is paid on the equity shareholders, we have to consider preference shareholders for payment of dividend. Next is repayment of capital at the time of winding up of the company. Preference shareholders are considered first before equity shareholders in case of repayment of capital. Fixed rate of dividend. Normally, preference shares are issued with a fixed rate of coupon rate of dividend. At that rate only, we have to give dividend to the preference shareholders whenever any dividend is declared on the preference shares, depending on the profits available with the company. Voting rights. As we already discussed, preference shareholders do not have any voting rights on the company except the matters which affect their rights directly. And at the time of winding up and reduction of capital, which is considered as the affecting their rights. Face value in the sense, normally the company issues preference shares with a face value of rupees 100, while equity shares are also issued with the face value or rupees 10. So many of the times the preference shares have face value of rupees 100. Preference for repayment of capital, as we discussed earlier in the first preferential treatment point, they have preference of repayment of capital at the time of winding up of the company. They are considered before equity shareholders, but not before the debt. If while after repaying all the debts of the company, if any amount is remaining, then preference shareholders are considered first for repayment of capital. Redemption of shares. So preference shareholders comes with the right of redemption. They get repaid within that 20 years time their capital. Nature of capital. So preference shareholder is a part of capital. However, they are not considered as the owners of the company. Like equity shareholder is a part. Equity share is a part of capital, and they have the ownership rights in the company. But preference shareholders do not get that right, even if they are formed as a part of capital of the company. So these are some basic characteristics of preference shareholders which we wanted to explain. Moving ahead on the next slide, that is types of preference shares. So these are the types of preference shares. I will discuss each in detail. So cumulative preference shares. It is a common type of preference shares where preference shareholders are entitled to receive dividends for years where dividends could not be paid by the company having inadequate profits. For example, suppose a company doesn't have sufficient profits in a particular year to pay out dividend to the shareholders. So in that case, it pays cumulative dividends in the following years as arrears if it makes adequate profit in the subsequent years. Cumulative preference shareholders enjoy the right to dividend even in the years in which the company do not have profits. So So these are transferred to the subsequent years, and whenever the company have the sufficient profit, then it declares dividend for earlier years also, and the company could not pay due to inavailability of profit. Then non-cumulative preference shares. Non-cumulative preference shareholders are not entitled to dividends for the year where the company could not pay due to losses or inadequate profits. So these preference shares do not get dividend for the years where the company has no profits or inadequate profits. Then redeemable preference shares. Companies issue redeemable preference shares to redeem them at a later stage. The law allows maximum time of 20 years for all the companies except infrastructure project companies, where it is 30 years. So this has to be redeemed within that period of time. So the preference shareholders get their money back after the specific period. Then non-redeemable preference shares. Irredeemable preference shares can be redeemed by a company only on liquidation or shutting down of the company. However, Companies Act do not permit the issuance of non-redeemable preference shares. It is mandatory to issue preference shares which are redeemable within the specific period of time. Participating preference shares. Participating preference shares stand a chance of earning more than the stated rate of fixed dividends. Since they are participating in nature, they can participate in surplus profits of the company. So other than the fixed rate of dividend and repayment of capital, they can get over and above that money depending on the profits and surplus of the company. On the other hand, non-participating preference shares are entitled to only prefixed dividend payments, and they are not entitled to participate in the surplus profits of the company. Convertible preference shares are converted into equity shares of the company at a specific price and time, depending on the terms and conditions at the time, which is decided at the time of issue of preference shares. So shareholders earn a fixed return through dividends and the possibility of higher returns if the company's share price increases upon the conversion into equity shares of the company. Non-convertible preference shares, we can say, are similar to redeemable preference shares. They are not converted into equity share capital and will be redeemed at the specific period of time. So these are the types of preference shares which can be issued by the companies. Moving ahead, here we are discussing the difference between equity shares and preference shares. So definition is equity shares represent the ownership of the company. They're considered as the owners of the company as they have powers in the management of the company. They have voting rights and they can decide on the like conducting of business of the company. Preference shareholders do not have that voting rights and hence they are not participating in the management of the company. Dividend. Equity shareholders receive dividend only after the dividend is paid to the preference shareholders. They do not have that preferential treatment in payment of dividend. In case the profit is not available, it is not mandatory to pay dividend on equity shareholders to the equity shareholders. Preference shares carry a fixed rate of dividend and preferential treatment in the payment of dividend. So the company has to pay dividend to the preference shareholders whenever there are sufficient profits and the dividend rate is fixed on the preference shareholders. Capital repayment, as we have already discussed, equity shareholders are considered last while prepaying at the time of winding up of the company. After paying all the debt of the company and the preference payment to the preference shareholders, then only if any money is remaining, surplus is remaining, then the equity shareholders are paid at last. Preference shareholders are paid before the equity shareholders, but after the debt is paid in case of winding up of the company. Participation in management decisions. So this is something which is available to equity shareholders. Equity shareholders have voting right and as a result, they participate in the management of the company. Preference shareholders do not have any right in the management decisions because they do not have any voting rights to decide on them in the conduct of business. Redemption. Equity share is a long-term source of finance which is redeemed only at the time of winding up of the company and not before that. Preference shareholders can be redeemed within the specific period of time. Convertibility. Equity shares are normally not convertible. Like they are not converted into anything, not into preference shares, not into debt. They remain till the life of the company. Preference shares can be converted into equity shares if we issue convertible preference shares. suitability in the sense equity shares are high risk takers, like depending on the condition of the company, that companies, if the company is making profit or not, if it goes into bankruptcy, then preference equity shares will not get anything at the end. However, preference shares are at a low risk because they have preferential treatment in payment of dividend, the repayment of capital also. Company's obligation. So company has no obligation on the equity shares to pay dividend to them. Only if it is earning well or it is having profits, then only they have to pay dividend to equity shareholders. However, preference shareholders to be considered, they have to give priority to the preference shareholders while in case of dividend and also in case of repayment of capital. Mandate.
There is a question has come. Can we issue optionally convertible preference share? In case of the non-cumulative preference share, not received dividend for the 2 years, then they will be entitled for the voting rights. This is the question asked.
Yeah, I think that second question of Silpa we have already answered, that even if dividend is not still they are entitled. I only raise this question, if the dividend, I will put simple, it is answered that way. If preference shareholder don't receive dividend, whether cumulative or non-cumulative, whether declared or not declared by the company, they get voting rights. Am I correct, Panel?
Correct.
Agreed.
Agreed, 100%.
Okay, so we have to answer now one question only. Can we issue optionally convertible debenture, convertible preferences?
Frankly, I have not come across such an issue, but should be possible. I mean, given that you issue optionally convertible debentures, I don't think there is any problem. But I have not tested it.
But since not prohibited, it's right that they can, right?
Yeah, legally it is possible because the law does not prohibit such issue. Convertible or optionally convertible.
Yeah, there are no restriction on this. That is directly given in the law.
Yeah, legally it is possible.
Interesting question.
Legally it is possible also, and there could be a variation in it. Sometimes option could be to both company also, that if it is a compulsorily convertible, then either company exercises on meeting certain parameters, or it could be by the investor also. Particularly those PE fund investors have this type of conditions.
Yeah,
it is possible. It is possible.
Okay. Okay, Suchita, carry on.
Yes. So mandate in the sense equity shares are compulsory to be issued at the time of incorporation only. There has to be certain capital in the company and it is mandatory to issue equity shares. However, preference shares, the company has an option. If they want to issue preference shares, they can issue. Otherwise, it is not mandatory to issue preference share capital. Financing. So equity share is a long-term source of finance because there is no option of redemption and they are there till the life of company. However, preference share is a medium to long-term source of finance, we can say, because if they are convertible, they are going to convert into equity share at a later stage. However, if they are redeemable, it is up to 20 years that the company can maintain the preference share capital. Liquidation preference. Equity shareholders are paid only after making payment to creditors and the preference shareholders if any surplus is remaining in the company. Preference shareholders get that preference over equity shares that they are paid before the equity shareholders are paid. Bankruptcy. So equity shareholders are paid only after after full payment is done to the preference shareholders. It is similar to the earlier point. And preference shareholders have a preferential claim over assets. Therefore, they are paid before the equity shareholders are paid. Now we'll look after some of the differences between debentures and preference shares, that is a debt and preference shares. So the debenture is a type of loan or debt instruments, and preference share capital. So the share capital which is carrying fixed rate of dividend and preference in the repayment of capital is known as preference share capital. Type that normally debenture is a type of debt, and as we already discussed, preference shares is it is coming under paid up share capital as per the definition given in the Companies Act, and so it is considered as a capital of the company. security. So debentures may be or may not be secured. Like we can issue, the company can issue secured debentures and also an unsecured debentures. However, preference shares are not secured in the nature, right? There is no security in case of preference shareholders, preference shares. They only have preferential treatment in dividend and the repayment of capital. There is no security that the company has to issue while issuing preference shares. Voting rights, debentures do not have any voting rights because it's a part of debt, and preference shareholders do get voting rights where their rights are affecting directly, but not in the all matters of the company. Risks, debentures are relatively safe because it is a debt and carry fixed rate of interest on it. Shareholders like preference shareholders also are at a risk because whenever the company do not have profit, it has that right key, it cannot declare dividend on preference shares. Priority as to repayment, in case of winding up, the debentures being the debt of the company is considered before preference shareholders also. It has that priority, and the preference shareholders are paid only after the all of the debt is paid and before the equity shareholders are paid. So these are some basic differences between debentures and the preference shares.